Hey everybody, we're back in the studio today. The market having a rough day. The S&P 500 down about 1%. The Nasdaq is leading the way lower with a 2% drop. And we got some retail earnings that are leading the market lower today. Home Depot really underperforming. That is a big dog in the retail space. We'll get Walmart after the bell today. We'll get Target tomorrow. So, of course, we're going to see some choppiness. The market really digesting what we've seen so far and kind of pricing in future expectations. Home Depot missing estimates on both the top and bottom line. Revenue was about $4 billion shy of estimates. Earnings were 16 cents a share light. And guidance also coming in lower for both revenue and earnings. Of course, the stock getting crushed, it's down about 8% as a result. Let's take a look at some of the other movers today. Nvidia, of course, getting a big boost on some really great earnings and great guidance. Nvidia crushing it. Facebook parent company Meta also reporting after the bell today. Amazon earnings and revenue beating estimates, but the stock is actually getting crushed because they gave weak guidance. And then we have Apple, which is reporting this Thursday. We'll get that after the bell on Thursday along with Tesla earnings. So a lot of big names reporting over these next 2 days. The market is obviously very much focused on forward guidance. If companies can't meet those lofty expectations, even if they beat estimates, the stocks are getting crushed like we're seeing from Amazon today. Here's a look at Amazon's chart. You can see over the last year the stock is actually up almost 50%. Pretty impressive performance. But today the stock is getting absolutely crushed. We have broken resistance, broken support. It's now trading below its 200-day moving average. This chart does not look pretty for Amazon right now. A lot of times when you see a stock break its 200-day moving average, it tends to continue lower. So I wouldn't be surprised if we see Amazon test the 90s here in the next couple of weeks. Also wanted to point out something very interesting. Take a look at the Russell 2000. The small cap index is actually outperforming the S&P 500 this year. The Russell 2000 is up about 7%, whereas the S&P is only up about 3%. This tells me that maybe there's some more room for upside potential in the stock market. A lot of times when you see the small cap index outperform the large cap index, it's because the market is looking towards future growth. Future growth is going to the smaller companies, not necessarily the larger companies. And a lot of times this happens at the end of bull markets. So could be a sign that we have more room to run. Of course, that's not guaranteed. Just something I found very interesting today. Here's a look at Home Depot's chart. You can see over the last 6 months the stock has been in an absolute free fall. Of course, today we got the weaker than expected earnings and revenue guidance, and the stock is getting absolutely crushed. Now, I want to point out something interesting on this chart. We have broken support. Broken resistance. Now, we're breaking the uptrend line of this channel, and this is significant because when price breaks a major swing low, a major swing high, or a trend line, it tends to continue through that level of support or resistance. So when we broke that trend line today, it's not surprising that the stock continued lower and lower and lower. I would not be surprised if we see the stock test the low 200s here in the next couple of weeks. Now, I want to turn our attention to Walmart. This is a name that I think could outperform in the future. It's one of my long-term picks. I love Walmart. I think the stock is a strong buy right now. The reason I like Walmart is because of their exposure to e-commerce. They're becoming an e-commerce giant. Their earnings and revenue are growing, and the stock is dirt cheap. If you look at the PE ratio, it's under 11. Look at the PEG ratio, it's under 2. The reason I like the PEG ratio is because we have to factor in that Walmart is growing earnings at a high rate right now. Right now, the company is expected to grow earnings by 7.5% next year. And in 5 years, they're expected to grow earnings at a 10% rate. So with the PEG ratio being under 2, I think Walmart is a screaming buy right now. I think it's undervalued. And I want to show you another interesting metric. When you compare Walmart's forward PE ratio to the S&P 500 forward PE ratio, you can see that Walmart is a huge discount. In fact, the biggest discount since the financial crisis. Walmart is trading at a huge discount to the broader market. And this makes perfect sense because Walmart is considered a defensive play. People will always need to go to Walmart to pick up necessities, whether the economy is booming or whether the economy is in a recession, and I think this is why Walmart is going to outperform in the future. So everybody, I hope this video was helpful. If you haven't seen my video on Walmart, I highly recommend checking it out. I think that's going to be a game changer for you.